G'day, Justin Hogg from Right Source. Budgeting crazy at the moment. Now, I really wanted to do something about helping everyone take their budgeting to the next level. Yes, there's levels, oh my God. So most people are familiar with budgeting in terms of profit and loss. What's your result for the year? That's what people see when they think about budgeting. It's like doing your profit and loss. Well, that's definitely a place to start. Where you want to take it is actually go to see, well, in that budget that you're doing, what does that budget create for you in terms of cash, in terms of assets, in terms of paying down debt or creating more debt? What does it create in terms of your financial position? Now, doing this, why this takes things to the next level is it gives you more integrity in your budget, plus also it gives you a better sight in terms of your cash requirements and how you're using debt. Also, whether you're spending stuff on assets for the business. So your profit and loss is generally speaking about your performance. Do you need to also invest in new vehicles, new desks, new computers, whatever? They're assets for the business that you might not actually, when you do your budget for your normal budget and your profit and loss, you might not actually be taking into account. So by doing your balance sheet, it actually makes you more aware of the value that you're creating in your business, not just the performance. So to do this, I've created a template. So we've done a previous video on your incremental budget. What I've taken now is that template we created in that video, and I've added a balance sheet to it. So what we can do is we can go through, we've already created a budget and a P&L, and we can go through the steps to take that P&L based budget and create a balance sheet that ties into it, which shows the value that you're creating in your business, gives you a little bit more understanding of what's happening in your business, and also shows you how your cash is tracking over that year for your budget. So we're going to dive into the computer and have a look. So here we've got the incremental budget template that we used in previous videos. We've had a profit and loss that we've completed previously. What we're going to do now is I'm going to show you how you take that profit and loss budget and add on your balance sheet budget to it through a relatively quick process. So let's dive in and have a look. So we've got the balance sheet tab. We'll go into that. So this is your balance sheet. Basically, it's got high level the types of accounts you'd have in your balance sheet, and we'll work through each of those accounts, how we populate those numbers to reflect what's happening in your business. But the first thing you have to do before you start populating that is actually put in your opening balances. So as at the start of your budget process, so let's say at 30 June, what are the balances in your balance sheet? So they're your actual opening position. Now you can see that that's it. We've put those in column B already. So you've got your how much cash you've got, your accounts receivable, assets, then all your liabilities, and also your retained earnings or owner's equity. So that's the first step, populating those, because that's where you're starting from your budget. Next, we don't start with cash. Cash is last. So first thing we start with is your accounts receivable, your debtors. So this is where you invoice customers and they pay you. So for different businesses, it can be, if you sell stuff over the counter, it can happen straight away. So what you invoice is what you sell and what you get paid for. For others, they get paid after the service is delivered or after the goods are received. So really it's about understanding how your business works and what you want to put in. Now, what we've got as the first two lines to it, so what's invoiced and what's received. So the invoice line basically reflects your sales that you're making, which comes out of your profit and loss. So you've got that in your profit and loss, what sales you're making. What you need to include in your accounts receivable is when you send someone an invoice, is you also include GST. So that's where the formula you can see in that line is your profit and loss, is your sales amount, but it adds 10% GST onto it, because that's what you'll need to collect from the customer. The next line is your receipts. So what do you expect to receive? Now, you can make this as complicated or simple as you like. If you want to say, well, basically everything I invoice, I expect to get the same amount in every month, well, we can do that and basically have what you receive be the same as what you invoice, and that's fine. There's nothing wrong with that. Or you could go through each month and say, well, seasonally people pay late in February because they realize their BAS is due, they have no money after Christmas, so usually those payments are late, so you don't get paid as much in February. So you can tweak it, but that's the point of doing this, is starting to think, well, how do people pay? And you might not know that off the top of your head. You might actually have to go back and look at historically what has happened, but then you start to understand your business and the timing of when these things will happen. The next line you look at is assets or capital. So I've kept this pretty simple for the time being because I'm going into selling stuff and depreciation. Basically, all I think you really need to do from a starting point is understand, well, what are you planning to buy during the year? Are you planning to buy new computers or a vehicle or some new desks? What are the assets that you haven't included in your profit and loss, the assets that you plan to buy during the year? Because that's quite important for your business to plan to do it. So let's say, yes, you are, and you're going to take advantage of the end of year financial sales and buy some more computers and maybe a vehicle towards the end of the financial year. So put them in. You've then increased the amount of assets you've got in your business from 150,000 at the start of the year to 195,000 at the end of the year, if everything goes to plan. So that's your assets. The next is looking at your liability, so what you owe others. The first line in this is your accounts payable. So what you need to pay for your bills, excluding employees, what you need to pay suppliers. So again, that comes straight out of your profit and loss. There's a formula there to help you. Again, it probably has GST on it. I've just made an assumption everything has GST payable on it, so we've included that. So that's what what suppliers are owed. The next, you need to work out, well, when are you going to pay them? Sort of the reverse of accounts receivable. So again, you can make this very simple and just say, well, I plan to pay everyone in the month that they send me an invoice. So that's that. So we've updated that. The next lot starts to get a little more complicated. So we go through, the next one is GST. So this relates to, obviously, you've both collected GST on your sales, probably, and you're paying GST to suppliers. So at some point, the net of this amount needs to get either remitted to the government or refunded back to you. So that's what this next line is. So we've got already built in here, so you don't have to do anything, some formulas taking the GST that you would receive off your sales. I mean, you can check this because depending on your business, you may or may not be charging GST. Similarly with purchases, there's the GST there. Then importantly, what we've got is when you need to pay the government. Now, the template's currently set up to be based on quarterly installments, so you need to remit quarterly, and that's there. Now, that then helps you understand, well, okay, what are the large chunks of money that are going to go out in terms of GST? Because hopefully if you're making a profit and you've got staff, you'll generally be paying GST. So it's good to know when those commitments are, and that's what that basically tells you. So not a whole lot you need to do there, just to make sure that what GST you're charging is right. Now, if you're a larger business or you remit monthly, again, you can modify the payments line here to reflect that a monthly payment, and the formula will update. The next one is PAYG. So this is where you withhold tax from your employees, and that gets remitted to the government as well. So again, I've got a calculation here which basically takes the wages that are in your budget and says, look, around 14% on average is what we withhold. It's something you can look at for your business depending on the type of employees you have. That percentage changes, but it's a rough estimate. That's what you withhold from their wages, so that will need to get remitted to the government. And again, when those payments occur, again, in this, I've got a quarterly setup, but again, it might be monthly, it might be annually, depending on your business. So again, it'll let you know when those big chunks of money are going to go out and when you're liable to pay. The next one's super. So running through this again, ties to wages. Comes in two lines, how much super you're liable to pay, which is effectively again derived from the budget you've made in terms of your employee costs. So there's a formula there for that. And when do you pay it? Again, super is payable quarterly, is when you are required to pay it. So that is set up in the template. You can pay it more frequently. I know some clients of mine like to pay, and myself like to pay superannuation more regularly than that to get the super into the employees' accounts so they can start earning benefits on it sooner, because that's sort of the point of paying super. But quarterly is all you need to do, so that's what's in the template to understand, again, your commitments. Lastly on that is loans. Now, so this could be director's loans, it could be loans with institutions, basically a facility that you have to get debt. And this, it's there for you to put in, well, when you look at your business, if you're going to purchase assets or you're running short on cash, or you're getting cash in and you want to pay down your loans, when you want to do that. And you can schedule that in your budget. So then you sort of have an idea of, well, I know some businesses really want to be debt free. They want to get rid of the debts. Well, how, using this P&L, this performance that I've put together and this expectation for the next year, based on my assumptions with my budget, how quickly can I pay off that debt? This can be really useful for businesses and really give you a sense of power in controlling the debt that you have in your business. Now, basically 2 lines, you could do it 1 line, it doesn't matter. But basically I split through funds drawn, so when you borrow money off the loan facility because you need more cash, or payments, so when you can pay it back. We'll tie this back in with the cash, which we'll do last, but basically at this stage we're just going to leave that blank. The last line, the last sort of to tie off the balance sheet, gives you your net assets, so how much you have, how much value you have. Now, there's arguments in terms of it's not really the value of your business, it's the value of assets. There's a technical difference there, but basically what your balance sheet is showing you from your budget is in 12 months time, how much do you own, how much do you owe, and what's the net. Now, that's what your net assets represent. It also is represented by your equity. So same as when you buy a home, you spend $500,000 for the home, you borrow $400,000, you own $100,000 of that house. That's your equity in the house, is $100,000. That's what your balance sheet shows, and that's sort of what ties off the model. So that's it, your balance sheet's done. Now, the last step, and I said cash, we'll do that last. So the last step is looking at cash. So you've got your P&L budget, so what you expect to do in terms of performance of your business for the year. You've now got your balance sheet in terms of when you're getting paid, when you're paying others, what liabilities you have, what assets you've got, what capital you're spending. What you can now see is that the result of all that is your cash. What is cash going to do during the year based on all these assumptions? And then what you can see, interestingly, is there's a couple of months there where you've got negative cash. So this is where you need to go in and go, okay, well, obviously I'll need to draw down on some of the loans for that. So in July, you're short a bit. So let's just say we're going to draw down $15,000 in July to meet that debt. So now you've got cash, and you've got cash throughout the year. Now, you could, if you wanted to, say, okay, well, I've got 60 grand in December, I might pay back a whole chunk of some debt. Now, and quite often, this is what people, if you say in reality, say it's December, they go, hey, we've got $67,000, let's pay back some debt, that's great. If you did that, what you're not realizing is you've got all these bills you're going to pay in February, March, and effectively in May, according to this budget, you're going to have only $3,000 in the bank. So if you pay that debt back, you want to be able to make sure you can actually redraw it again when you need it again. So there's nothing wrong with paying some debt, saving some interest, but make sure you know that you can then redraw it to pay it again. So that's basically it. The last thing I would do, I'd say, is there's a notes column here. So where you are making assumptions, to say you want to say, oh look, we want to be more precise in terms of your receipts, put some notes down in terms of how your assumptions were created. So that way, when you come back and revisit this, you'll know how it's built. And lastly, report against it. So it's very interesting to pull this out and look at it on a monthly or every second month and go, well, what's my actual balance sheet say? And what did I budget that my business value would be? And where's the difference? Because it can show you that maybe the debtors aren't paying as quick, or you've bought some more assets you didn't plan. So it just helps give you, again, a little bit more information about your business, and helps you learn your business a bit better, and helps you be able to understand the things that are driving your business. So that's it, that's your template. If you're interested in getting a copy of the template and working through, again, this video together, chuck your details in below, put in the description balance sheet template, and I'll send you through an email with the budget template, and you can work through that together. If you're interested in getting some help in taking your budgeting to the next level, again, send you through your details, put in the description what you're after, and I'll definitely get back in touch with you. Or feel free to connect on LinkedIn, or subscribe to the channel, because there are definitely a lot of videos we're doing around budgeting and helping create a budget that gives value to your business, because that's what we're all about. So for now, that's it. Justin Hogg from RightSource. I'll talk to you later.